Folks, in today's video, I want to talk about how to gain COVID-19 resistant profits with my 3 top biotech ETFs. Now, before I talk about these ETFs, let's talk about the overall case. A few days ago, we heard from Russia that Putin's daughter, and they did a very, I don't know if it was a study or what it is, but they gave 100 people their drug and it seemed to work. I wouldn't put too much faith into that. But I do know that Pfizer and Moderna are literally on the brinks of releasing something substantive. And these two companies are credible companies. They're going to go through all the due diligence. They're not going to give us something that doesn't work or something that's going to make us more sick, if you will. But here's something I want to talk about, and I raised this with a few of our wealth press gurus a few days ago, a few of our guys, and we talked about this. And you know what's interesting is I'm looking at a bunch of stocks, individual stocks, and I'm seeing stocks that are predicting that they're going to come out with a virus or a vaccine cure, or however you want to call it, a cure for COVID-19 later on in the year, or maybe even second quarter of next year. And the accumulation on those levels, on those stocks, are in line with the accumulation levels that we're seeing in stocks that are supposed to come out with a vaccine as early as a month and a half from now, which is very interesting. But it makes me think of something that I touched on at another broadcast that I did a few days ago. The fact is this: if you guys remember back in the 90s, early 90s, or maybe even late 80s, time gets away from me, and I'm not that young to begin with. When Prozac came out, when Lilly came out with Prozac, I remember several other companies were in the works. The Prozac is an SSRI. It's a serotonin uptake inhibitor. It increases the production of serotonin in your brain. And I was thinking, wow, they just created something completely new. It was a new type of antidepressant. And other companies were like Pfizer, and I know there was Zoloft and Paxil. All these other products, which are very similar, came out about a year or 2 years later. But here's the thing: not everybody responded to Prozac, and a lot of people responded but had too many side effects. And I think we're going to see something very similar with these vaccines that start coming out right away. A, I don't think we're going to have enough for everybody. B, I don't think they're going to work on everybody. C, I think some people are going to have side effects. And the bottom line is there's room for more. There's always room for more, especially a vaccine for a new disease that's completely terrorizing the world. But my point is this: instead of looking at individual stocks that may come out with a vaccine for COVID-19, you might be better off, especially right now, because we've seen, remember, stocks and markets and price action, price discovery looks ahead. And right now, all the profits, all the upside that are going to be seen in companies like Moderna as a result of them coming out with COVID, it's already priced in. Overnight, Moderna went up, I think, from $68 to $78. At least it looked overnight. So a lot of what will happen is already reflected in the price of the stock, in these large cap COVID-19 stocks. So one of the things I would do, and I usually, after I see a big run in stocks, what I tend to do is I liquidate the stock and I'll put the money in an ETF. We did this recently with technology. I believe technology was peaking out a few weeks ago. So I said, you know what, guys, let's not get out of technology. Let's just rotate out of individual stocks and put money into technology ETFs. And the reason for that is simple. If there's a big down move, if there's a correction, we already took profits, or the majority of profits. We are still in tech, but now we're diversified in 20, 30 stocks, which is what an ETF is. It's a mini hedge fund, mini fund. So if there is a downside move, it's not going to be as pronounced as it will be in individual stocks. So in other words, we'll still gain some of the benefit. At the same time, our risk will be reduced. And now I'm doing exactly the same thing. That's the advice I gave for technology. And now I'm taking the exact same advice and I'm applying it to biotech, because I'm seeing a lot of the gains just beginning to fizzle out. Now, it may be a pullback, or it may be the fact that most of the price discovery and the impact that these drugs will have on our society have already been priced into the stock. It's too early to tell. So I'm seeing that momentum curve slow down, and I'm actually seeing drug stocks take a backseat to transport stocks and defensive stocks. That could be a warning sign. But at the same time, I don't want to make foolish mistakes and completely get you out of biotech. So what I suggest is you look at these 3 ETFs that still give us the potential for upside, but at the same time, spread the risk wide. In other words, one stock can go down 20%, whereas this ETF may lose 0.5% or 1%. But I think you understand what I'm saying. So let's go through the 3 of them. The first one is the S&P Biotech, ticker symbol XBI. It's a solid ETF. It's got great liquidity. And again, if you look at the constituents, you will see it's got 136 biotech holdings. So your risk is spread out really well. The top 10% only hold 18%. So you're really well diversified. And look at this. It's got Novavax, Sorrenta, all the usual suspects are here. Everything you could possibly want. There's huge exposure to COVID-19. BMRN is here. That's one of my favorite stocks right now. Immunomedics is here. So you could see just very, very quickly looking through this, you could see there's tons and tons of stocks here that give you exposure to COVID-19 type of ailments. Now let's look at the next one. This is the ARC Genomen Revolution Multi-Sector ETF. Again, it still hasn't peaked out yet. It's still going higher. And again, if you look at the constituents, always look at the constituents. You will see very, very quickly, and it only has 34 holdings. Top 10 account for 59%, so it's a little top heavy. Doesn't have the exposure, but again, it's better than being in one stock. Crisp Therapeutics, Illumina, Adidas, all these drugs have some exposure to COVID-19, or at least some of them do. And again, you don't want to put all your eggs in one basket. So finally, we have FBT. This is a biotechnology index, New York Stock Exchange. And again, if you look at constituents, this one started cooling off. It has 32 components, and the top 10 accounts for 35%. But again, Biogen, right at the top. QGen, Regeneron. Look at Regeneron is 3.43%. So you're not putting all your eggs in one basket. You got plenty of exposure. You got BMRN. You got Alexion. You got all the stocks that are giving you some exposure. Guild is here. But at the same time, you're not overly exposed. What I like about this about this ETF is most of the stocks in this, if you look all the way almost till the end, they all have around 3.25. So you're getting, so imagine one stock dumps in half. Well, you're down 1.5%. If you had the stock, you'd be down 50% versus 1.75, 1.5%. So you see what I mean? It's much better because look, you put your money in this, you wait for the biotechs to take a dump, and then you get back into the stocks and you move away. So you shift between ETFs and individual stocks. That's the best way to do it. So again, the best way, and this doesn't just apply to biotechs. This applies to any sector. When you're seeing the beginning of a trend, it's great to be in individual stocks. But once that trend has had some time to capitalize and you're waiting for a pullback, but you're not 100% sure if you're going to get that pullback or not, you go into ETFs. You wait for that pullback, you wait for that congestion, then you see exposure again, you see a catalyst, you see new news, you get into the stocks again. You go between stocks and ETFs, and then you can go stocks, ETFs, cash, stocks, ETFs, cash. But now you're trading defensively. You're looking to gain the most upside, and when the time for downside comes, your risk is diversified. Again, all these things will help you trade like a hedge fund. The 3 ticker symbols are XBI, that's the S&P Biotech Spider. Then you have the FBT, which is the New York Stock Exchange Biotechnology Index. Both are good, just depends on if you want 150 stocks in the index, less exposure individually or more. And then you have the ARKG. And again, just depends what you're looking for. The ticker symbol is ARKG. The other one is FBT, that's the New York one, and the S&P 500 is XBI. And I hope that helps. Folks, there's a new wave of investing that's knocked some of the best investors right off track, but it can result in you making north of $1.8 million. I'm not taking that or saying that lightly. $1.8 million. Can you imagine making that? Even legendary investors like Warren Buffett were completely, utterly, and totally blindsided. They missed out. I can't say it any other way. And now everyone wants to know where the Robinhood effect is going to strike next. I can tell you now, the next big winners are not on your radar. You won't find them the old-fashioned way by crunching numbers, analyzing balance sheets, or staring for hours at weird chart patterns that hardly make any sense. It's actually much, much easier than that. It'll take you about 10 minutes per week, and it could earn you up to 339% on your money every single week. Not every year, not every month, every week. Click the link below to jump in before the next Robinhood takeover. Do it now.